What's up, guys? It's your boy Quick Stocks. As always, remember to hit those thumbs to recharge my dopamine, and we will get right into your quick stock analysis of Amazon. Ticker symbol AMZN, trading for $2,483 a share as of June 6, 2020, equating to a $1.25 trillion market cap and an extremely rich PE or price per earnings ratio of 113. We all know Amazon has been on a massive tear, but it still blows my mind that Amazon has seen an increase in share price of nearly 2,000% in the last 10 years and 477% in the last 5 years. Investors in Amazon certainly have been massively rewarded. So what's the move? Are we riding with Bezos to outer space, or are we cashing out and taking that sweet, sweet money back guarantee? This is your quick stock analysis. For transparency's sake, it's important to note we already have a position in Amazon with a whopping 3 shares. Yeah, it's kind of a big deal. But for real, remember, Amazon is trading for nearly $2,500 a share, which equates to nearly a $7,500 position for us. Alright, let's get into it. It's pretty clear Amazon is benefiting as consumers around the world are shopping online to a degree never seen before. But for real, this is bonkers, boys. Let's take a look at what is exactly under Amazon's umbrella. Of course, we have the largest online retailer in the world, but we also have Amazon Maritime, which enables the company to manage its own shipments from China into the US, Annapurna Labs, which is an Israel-based microelectronic company, of course Audible, the largest online audiobook collection, some more trucking and air freight logistic companies, Comixology, a cloud-based digital comics platform, Lab 126, the developers of integrated consumer electronics such as Kindle, Ring, a manufacturer of smart devices, Sook, the largest e-commerce provider in the Middle East, Twitch, the live video streaming platform, Whole Foods, Alexa, which is not only Amazon's digital assistant, but they also own a company called Alexa, who is an analytics provider, and honestly way more, but I'll spare you guys. To no surprise, with a collection of companies and products like that, Amazon has been many long-term investors' favorite companies, as typically when you invest in a company, you have to choose between relatively safe but consistent growth or higher risk, higher reward investments. As, like we stated, in the last 5 years, Amazon has seen a 477% increase in share price, which is bonkers, boys. And the best part is you don't have the same level of risk you would expect from a company growing at this rate. Granted, Amazon investors are starting to have their own liability, not so much regarding the success of the company, but more so outside factors such as union and monopoly busters. I'm looking at you, Papa Elon. But for real, let's take a look at some numbers. In 2019, Amazon reported a net income of $11.5 billion US, up from $10 billion in 2018. And Amazon is expected to have around a $13 billion net income in 2020, which is really anyone's guess when you take into account our current economic situation. However, it is important to note Amazon intentionally posts lower profit, as it takes the vast majority of the money it earns and invests it right back into the company so that it will profit all the more in the future, which is represented by the rapid growth, especially for a company of Amazon's size. However, I really gotta point out the bull case. In 2019, Amazon had an EPS, or earnings per share, of $23, and with its current share price of $2,483. That gives Amazon a PE of over 118 and a forward PE of nearly 100. So when you purchase Amazon at these levels, you're investing more than $118 for every dollar of annual earnings, at least when compared to 2019. Just to illustrate how insane this is, when we look at Microsoft and Apple, both large tech companies with over a $1 trillion market cap, we see Microsoft has a PE of 31 and Apple has a PE of 25. So one could certainly argue Amazon's PE and forward PE seems astronomical. Maybe Amazon's PEG will give us some more clarity. And of course, PEG is price divided earnings to growth ratio, which many investors prefer over the standard price per earnings ratio. Amazon's PEG is $4.90, which is still rich when compared to the internet commerce industry PEG ratio of $1.57. So what's the deal? We all know Amazon is going to keep crushing it, but can it live up to the hype? Let's take a look at where Amazon's money's coming from. Of course, we have Amazon Web Service, or AWS, which accounted for 11% of Amazon's total revenue in Q4 2019, which makes sense. In all honesty, Amazon's web service pioneered the commercial cloud industry and has been massively rewarded for it. And when you look at market share, AWS is still leaps above their competitors, such as another quick stock company choice, Microsoft. However, it is important to note competitors are investing heavily to increase their market share. But with the commercial cloud industry expected to grow around 20% yearly, that still gives Amazon plenty of growth capability ahead for decades to come, which certainly has been the case historically when we look at it. When we look at Q1 2020, AWS picked up over $10 billion in revenue, which was a growth profit of nearly 30%. When compared to Q4 2018. Now let's take a look at Amazon Prime, which has over 150 million paid Prime members around the world, up from 100 million paid Prime members in April 2018. Subscription services were up 32% to $5.25 billion. This segment mainly consists of Amazon Prime, but also includes segments such as Kindle, Amazon Music, Amazon Pantry, Amazon Fresh, magazine subscriptions, Amazon Home Services, Amazon Drive, and Audible. And then we have Amazon's other category, which mainly covers the company's advertising business, which was up 41% to nearly $5 billion in revenue. Let's switch it up and preach a little philosophy. I don't think the effects of the virus are going to just disappear. Even when the quarantine lifts, it wouldn't be a stretch to assume people are still going to try to limit unnecessary interaction. And let's be real, this is going to benefit Amazon. The idea you can order your loot without having to go to a store that thousands of people have traveled through every day, and it will come directly to your house. No one can argue the benefits in store for Amazon's e-commerce. However, just to note the bear case, it is really hard to pinpoint what the outcome of the virus is going to be. Are jobs going to come back? Are we going to have a second wave? Etc. Which, here at Quick Stocks, we do not have the answers to. However, it certainly is in the cards to see a slowdown in the economy for years to come, which obviously would affect Amazon. On the flip side, if we see more stimulus checks, of course we will see share prices increase. Not only for inflation, but a lot of the stimulus money will make its way back to Amazon. They want your money and have a service you want in exchange for it. Also, Amazon's cloud services help customers handle remote computing power, scaling up and down usage. Amazon has already steadily replaced the old model of organizations building and owning their own servers and data centers, which of course takes time, requires large upfront capital, and maintenance cost. Honestly, the quarantine forced many companies to adapt to the technology faster than they would have, meaning we are going to see a massive increase in Amazon's cloud service in 2020 and potentially for decades to come. But we got to take into consideration what CEO Jeff Bezos said. Under normal circumstances, in the coming Q2, we'd expect to make some $4 billion or more in operating profit. But these aren't normal circumstances. Instead, we expect to spend the entirety of that $4 billion and perhaps a bit more on CV-related expenses, getting products to customers and keeping employees safe. This includes protective equipment, enhanced cleaning, less efficient processes, and higher wages, meaning a shareholder should expect a disappointing quarter at least from a profit perspective. However, the market's already expecting this, and I could definitely see Amazon beating estimates, giving the company yet another catalyst for growth. So what's my move? Honestly, I'm super bullish on Amazon, and I believe they will weather any of the storms to come, and continue to be more and more ingrained in people's lives around the world. And yes, they are overvalued. However, most quality companies are overvalued at this point. Interest rates are at a record low, meaning the stock market is many investors' best option who have extra cash and want companies with a solid foundation, with a lot of future growth. That is going to be able to handle any short-term tailwinds. And let's be honest, that's a company like Amazon. However, I have no doubt we will see a correction in share price, if I had to guess, sooner than later. And for a conservative investor, I wouldn't necessarily want to start a position today. In fact, many people could argue that it's a terrible time to buy almost any stock. If you wanted to wait for the next correction before backing up the truck, I definitely support that. I also completely support the idea of dollar cost averaging, where you invest a set amount of money into the market monthly regardless of market noise. Which, considering Amazon is nearly $2,500, you'll probably have to find a brokerage that allows you to buy fractional shares. Considering we already have a $7,500 position, I'm not necessarily comfortable increasing my price per share when Amazon is already at all-time highs and is a decent sized position in our portfolio. So I'm not going to pick up any more shares unless we see a correction, but I'm also not going to sell any of my shares. Anyways guys, that's all we've got for today. As always, the best investment you can make is to go long on quick stocks. Hit that subscribe button now at 350 subscribers and plan an early retirement. I'll catch you guys in the next one.